Good morning to everybody, and welcome to our performance update and outlook on the Hedge Invest Numen Credit Fund, our UCITS fund. We managed to send a quick presentation before just to support the presentation. As you can move to page 2, there's a quick snapshot of where we stand right now. As you know, we started in October 2012. At the moment, for the year 2014, we're netting a performance close to 4.5%. Year to date. Of course, we had some pretty heavy months for us. I think some of the worst probably since the inception of the fund during the month of July and August. And we dedicated to those actually some of the last slides of the presentation, as most of the losses were related to some subordinated security in Banco Espírito Santo, the Portuguese bank. We've been involved. Away from that, as I said, we had already a decent start of the month in September. We're netting close to a little bit more than 20 basis points. And we want to give you an update in terms of where we stand with the current most recent market development and how we intend to adapt or construct the portfolio to take fully advantage of those. If we move to page 3 and page 4, we just want to give a quick snapshot of what do we see out there in the marketplace. There are two big relevant items we're looking at. One is the word post-ECB announcement, beginning of September, and actually with and following Mr. Draghi's speech at the Jackson Hole at the end of August. As we were expecting, as we pointed out in the past, and most of our investors know, we've been increasingly positive on ECB response and a more aggressive stance. I think we've seen quite a bit of an upgrade in terms of the ECB activity with the September announcement about the TLTRO and a potential asset-backed security and covered bonds program. On the other side, we have been a little bit concerned by the fact that the very decision to use those instruments may actually postpone a more full-fledged quantitative easing the same way we have seen or experienced in US or Japan. And so we are cautious because of that. And we also think that as things progress, they may actually be accompanied by some sort of a trade-off in terms of fiscal commitment from the authority for the ECB to engage into something else. What is interesting, and irrespective of the specific expectations about additional ECB activity in Europe, is to focus on what we call the inescapable laws of bond math and what that means for the portfolio constructions. We pointed out the attention in this slide to a simple fact that both BTP, the Italian government bonds, and the bonus, the Spanish ones, in the 5-year bucket, they trade very close to 1% yield to maturity, which by accident happens to be also the yield to maturity we see on the 10-year government bonds issued by Germany. Now, as rates have progressed very close to zero, and even more so after the ECB actions over the last couple of few weeks, we need to be mindful of a few very hard facts about fixed income security, right? And that's what we're trying to put in a simple way on the right-hand side of the page. With rates this low, basically your base case scenario that you will be enjoying a sort of a 1% compounding rate, whether it's BTP or bond in 5 years. That's pretty much what the capital you will be returned over the 5 year on a yearly basis, on a compounding basis, it will be 1%. And this is assuming also that you will be reinvesting some of the coupon coming in at 1%. Now, that is the base case. Of course, there is a very positive expectation, which may also partially priced in the market, which is that we will see an additional upgrade of the ECB actions, and or for that matter, to another central bank jurisdiction. And this is we are running this analysis for Europe because it's our focus, but you could very easily export that to other countries like US or Japan or UK, right? But the best case scenario is that, of course, we see a full-fledged quantitative easing program, right, where basically ECB comes and start buying any and every government bonds they decide to put their hands on with no restriction, whether it is on the size or term structure or anything else. In that case, the best you will gain on your 5-year BTP or 5-year bonds will be effectively to present value all the next cash flow as of now. So you will get par plus the 5-year coupon, the 5-yearly coupon of 1%. That basically means you will get 105, and then be effectively cashed onto your security, because you will basically have no return at that point. That basically means that if you buy into those securities at this point in time with this kind of yield, then effectively your best case scenario, you'll be making 5% return. It could be 5% on BTP or bonus, it could be 10% in the case of the Bund, but that basically assumes that rates will effectively collapse on the back of the quantitative easing to zero. So zero yield across the term structure, which, as we know, is a bit of an extreme assumption, especially if you consider Japan as potentially the sort of floor, and even in the case of Japan, we have even the 5-year bond that's trading at around 20 basis points, and the 10-year is trading at around 55, 56 basis points. So basically, the kind of gains that we see, they will probably be halved if we see QE, and the only end result of the QE is to get to the, if you want, to the Japanese threshold. This is quite relevant because then at the same time it gives you a sense of what your upside downside. Now, we know that the upside in the best, most extreme theoretical scenario is anywhere between 5 to 10%, depending how long dated you go. At the same time, of course, there is a risk of, and there are two main risks at this level, which is true for Europe, but it's also true for the rest of the world. There's one risk, which is the traditional macro risk, which is inflation and potential increase in interest rates. The other is, of course, credit risk. That's something which is less relevant and less evident given the low rates, absolute low rates, but at the same time it's something that has to be considered because the duration across the fixed income world is very high. As yield goes to zero, as coupons go to zero, effectively the duration of the bonds goes very close to the maximum theoretical value, which is the exact term of the maturity. So it will be 5 in the case of a 5-year or 10 in the case of a 10-year. We're spending a lot of time on this sort of downside-upside because then we move to page 4 of the analysis, which is the way we're looking at the world now, and we seem to be receiving very conflicting messages from both the fixed income and the equity world. The fixed income world is effectively telling us that rates are very low, they're here to stay. This seems to be like a relatively structural issue. And the expectation of the market is that effectively central banks will continue into this sort of expansionary monetary policy, and maybe at a slower pace like the Fed, maybe at a quicker and faster, more aggressive pace like the ECB, but eventually they'll keep on going with those policies, even if the results are not necessarily impressive. And so it seems like the fixed income seems to believe that there is a bit of a structural issue here to keep in mind. There's low, rates will be low for a long time, and it seems inflation also is going to be low for a long time. And so that's a relatively important implicit expectation of the fixed income market. And it is affecting any fixed income security, whether it is German Bund or Japanese bond, all the way down to a yield in distress. At the same time, if you then change perspective and we look at the equity market seems actually to have a relatively more sanguine view about the current cycle and the current situation of the economies, and it seems to dismiss most of the kind of low for long or either inflation or growth or whatever, and view them as a more of a cyclical issue, which is we sort of trying to exit. So it doesn't seem to believe in a structural deflation or persistent unemployment. Now, what is interesting for us is, as of now, we start seeing that this sort of the differentiating views are becoming more and more relevant because of the valuation are making them more relevant. I.e., we are reaching all-time highs on fixed income, but at the same time we're reaching all-time on equity, and they go up in valuation typically for situation which would create actually the opposite effect. So that's quite relevant for us, and that's one of the reasons why we are more comfortable with our offering of having an absolute return now than ever before, because before was always been relatively difficult for us to compete with a long-only strategy as long as it was long-only in aggressive segment of the fixed income market. Now I feel, given the the valuation, given the discrepancy in terms of the message we're getting from the market, the absolute return approach is probably the most compelling and the most intelligent that we should try to have right now. How does it leave us with respect to the specific credit market, especially in Europe that we are focusing on? And we dedicated page 5 to that. How credit market look? I mean, credit market looks relatively cheap still, especially if your benchmark is the so-called risk-free government bonds. There is a decent amount of value, which is part of, I guess, some of the performance that we had, the negative performance we had during the summer, that a lot of the pocket of value that we're exposed to, especially in the periphery in Europe, haven't really, or largely haven't really changed massively. They haven't really enjoyed the rally we've seen in the sort of more kind of core periphery, so let's say Italy or Spain. And I think on that there is still a decent amount of value. Overall credit, and we're looking, for example, at a simple case like the spread of a corporate investment grade, that's in the first line. January 2008, it was around 70 basis points. Fast forward to February 2013, and is 59 basis points. And allegedly the credit picture is probably improved. What is totally different from there to now is the absolute level of rates. So if you look at on an absolute basis, then corporate investment grade spread seems to be a little bit more expensive than in January 2008, but nothing massive. But if you look at the versus rates, then it looks still very, very attractive. On the yield side, that's where we get a relatively different message. Yes, it's still cheap versus absolute rate, but is very, very expensive compared to where it used to be. And that's when you really need to make a call on which market is right. Is that a fixed income market, in which case a yield is a very dangerous place to be, or it is the equity market, in which case a yield is a relatively safe place to be once you sort of hedge your pure duration risk with risk-free rate. Of course, the other issue is when it comes down to government bonds, and that's where we dedicated the remainder of the slide. And again, the most striking example is the Bund. Most of our investors probably heard our views on the fact that Germany is probably one of the, if not the most mispriced credit risk out there. The 10-year Bund has moved from 4 to 1%. We think at that point it doesn't reflect much of the increasing amount of credit risk that Germany will be exposed to, especially in the case of a reduced level of growth, which would be the scenario that then would warrant additional central bank policy, which seems to be incorporated in the price. So on that side, if again I look at the core of the area, I think that's where we see the big pockets of overvaluation. So whether it is Germany, France, or anything else, we were quite worried. When it comes down to Italy and Spain, we've seen a very, very strong rally. And again, I dedicated the 5-year bonus and BTP the previous slide, because I think that the 1% is quite striking, especially for somebody that like myself has been looking at investing in Italian security for the last 25 years. What is interesting for us there when we look at Italy and Spain is part is the historical perspective, of course, but part also is the fact that as opposed to Greece in 2012, where the market value of debt over GDP was a fraction of the nominal debt over GDP, because we're talking about like high double digits versus high triple digits, right? In the case of Italy, actually, and Spain as well, we have a situation where actually the market capitalization of government debt issued by those countries far exceeds the actual nominal value of the debt, which means that the market is not particularly ready to offer a market solution or a price solution there. And because of the current action, we are in a situation where as the rates go lower, they make aggressive quantity easing probably the only solution if there is no growth, or alternatively make the other binary scenario more likely, which is some form of debt restructuring or debt rescheduling or soft or hard version of that. And that, of course, in the case that growth doesn't materialize, right? Then if we look at on the opposite side, on the periphery, we look at the more like kind of extreme periphery, whether it's Greece and Cyprus. We still see big buckets of value there. We still think those names are quite undervalued, and not much on an outright basis versus Germany or France, but more like versus the rest of the core, like let's say Spain, Italy, and possibly even France. We've seen some of those countries, especially Greece and Cyprus, going through quite a bit of their necessary restructuring. We still need to see some advancement when it comes down to Spain, Italy, and definitely France. So at the moment, once you look at the fixed income and once you look at the pure fixed income and then you look at the pure equity market, you seem to be getting some relatively strong messages from either of them that you may agree or disagree with them. At the end of the day, it comes down to what is your expectation on growth. And we told our investor many times, we do not have a crystal ball and we do not pretend to have one. So we refrain from making forecasting on growth and anything else. But one thing which is clear is that I think over the next few months or quarters, the economic data will be increasingly irrelevant because they would effectively make one of the two kind of school of thoughts, the winner or the loser, and they would have big implications for the markets. One reason more why we're trying to be as agile, nimble, and as opportunistic as we can going forward, because I think there will be plenty of opportunities. When it comes down to credit market, as I said, I mean, the interesting thing there is that you need to be very discerning and very detailed about where you want to be. There are great long and great short opportunity, and that's something which is as diversified as ever been for us, especially given the macro context of risk-free and sort of equity market. Then that opens up the page, the next, which is page 6. How do we intend to make money? And as I said, it will be it will be truly absolute return in the sense that there are several opportunities where we see opportunities long and short. I mean, we discussed about the core and periphery already. Overall, I think are paid now to have a relatively short bias on government bond rates. Especially the higher the valuation, the better it is, because they look more and more like an insurance policy. I think when it comes down to the periphery, I think there is plenty of value, and I think we'll see more post-AQR stress test. I think there is a lot of pent-up demand and a lot of pent-up liquidity which is building up, and that cautious approach has been increased by geopolitical risk, by the Scotland referendum and everything else. Over the end of the year, I think probably the end of October already, we'll start seeing a lot of liquidity in Europe being more available, whether it is the money coming from TLTRO, whether it is money that banks have kept frozen, so to speak, because of AQR stress test, whether it's going to be investment money or fund money that's been very cautious, very much on the sideline because of all the various risks in the world. But I think we'll see plenty of that money to be put at risk and put at play. So on that, again, view is to be relatively negative on super risk-free assets, or as risk-free as it gets. And be more constructive, definitely on the periphery of Europe, and definitely across some credit risk. In terms of credit risk, the one we tend to be focused on, which again is very much a capital structure approach, is the banking side. I think banks have two major issues, two major deadline right now. One, of course, is the AQR stress test. We think there may be a little bit more failures than what the market is expecting, but at the same time, we think they'll be pretty much marginal, as in they won't require any draconian measurements like we've seen with Banco Espirito Santo. It'll probably more like a gentle push reminder from the ECB that they need to do a little bit more. And we think that pressure is from the ECB anyhow, and it will be there anyhow, even if they do all pass the test. Let's not forget that this test, whether it's called AQR stress test or a combination of, it will be an ongoing yearly appointment. So the ECB will do every year, and so there will be an ongoing pressure. We think in the medium term that pressure will probably materialize into a pressure to engage into more mergers and acquisitions. We think the interest from the ECB is to remove more and more the market fragmentation, and so because of that, one very easy way is to create more either national or even better pan-European banking champions, and I think there will be a decent acceleration there post AQR stress test. The other big event, which we discussed already in the case of European banks, is the TLTRO. You can be skeptical on the ABS, and we partially are. We need to wait quite a few details next October when the ECB reconvenes, but it is undebatable that now banks can take anywhere between 0 to 400 billion of TLTRO between now and December. January, February, there will be a repayment of the old one, the very one, the first two LTRO. But once those are repaid, again, between then and between March 15 and then all the way down to June 16, there will be pretty much every quarter another capital injection from the ECB, and that's just from the TLTRO. So we think banks will be flush with very, very cheap funding, and then at the same time there will be a decent amount of M&A activity. So that's an area where we're super focused. We keep on spending money and time and resources on that. We think there will be plenty of opportunity. There will be long, short capital structure. It will be very much event-driven, but that's something we're very focused. On the pure corporate credit, those are the two last kind of buckets that we put there. Perversely, investment grade still looks very attractive, very cheap, although the absolute return are very minor, but that's something to appreciate. At the same time, where we see the most dangerous names are definitely the yield kind of stress, lower than investment grade kind of issues. And we've seen a few reminders recently. The latest one has probably been Phones for You in UK. But I think there are a lot of business models which are very unsustainable, which have been over-levered thanks to the market and thanks to the strong market. And I think that there will be a lot of bad surprises on that segment. So again, we try to approach from the short side. Moving to the specific portfolio analysis, as I said, just to kind of, if you go to page 8, just to sort of summarize with a bit of a picture there in terms of where we're going to be focused and where not. I think macro is still going to be a big play for us, long, short, and European sovereign issuers. I think you start getting the view, I mean, on the bond we feel we sort of arrived. We think there's an increasing amount of credit risk there, very dangerous place to be. Maybe a tactical trading opportunity from time to time, but overall we think it's one of the best short opportunity going forward. As I said, the downside is what it is. I mean, I think the downside on a 10-year bond may be 10% if rates goes to zero, maybe 5-6% if they go to Japanese levels. It may be 2 or 3 really. Kind of best case scenario with the highest level of probability attached. So if there is your upside, your downside is quite substantial. And I think for us, when it comes down to Germany, it's a combination of A, the market appreciating that their credit exposure to the rest of Europe is increasing massively, and B, of course, then nobody really expects central bank policy to ever work, but they may work, or even worse, they don't work because they don't produce growth, but they do work because they produce inflation. So I think there is where we're really negative. Periphery, we discussed at length, is really a name-by-name basis and pieces by pieces and term structure by term structure. So there we will have long and short, but we think there's value there. Bank capital, as I said, totally agnostic, event-driven capital structure approach. We view there's a lot of positive momentum coming from banks in the next 2 to 3 months, and very concentrated into the year end. Investment grade and special situation. I think investment grade, we like it. It's not exciting, but is not short either. On the other side, when it comes down to special situation, a yield, I think the idea is to start from a short side, and I think shorts will play out there. One reason more to be fully focused on the absolute return kind of strategy rather than long only right now. We then, at page 9, we provided some sort of more granular details about which were being the positive and negative contributors strategy by strategy. As you've seen, like during the summer, of course, it was a big surprise for us on the banks. We had a very detailed but wrong call on Beth. I think we had the right view since the beginning. It was a bit of a fraud at the holding company, but we had the wrong call on the specific security, and the sort of hedges we had, they were not enough to absorb the scenario, which we view it, but we didn't view as likely as the others that we had in mind. But we'll go through that in details. Here you can find, I know that the fund is relatively young. I mean, we've been around for probably not even 2 years, but getting close to two years next month. The drivers that we had until now, I think going forward, I would expect even more to come from government and financial, but I think an increasing portion will probably be short on the corporate side that should produce good performance. We then have the similar sort of information, but in a different slide at page 10, where we just go the cumulated returns by sub-strategy. As you've seen, for us, corporate bond has been really minor. Part of that is because we've been cautious and nervous about overvaluation for some time, but they were not enough for us to trigger like short position. I think as of now, given where we are, given the absolute level of rates, that there will be good opportunity there on the short side. On the financial government side is as before, and I think if anything, the opportunity will be richer than what we've seen for the last couple of years. Again, you see here on the short and long side, I mean, we had performance from both in terms of where we made, where we didn't make money. Our shortish bias hasn't really produced any meaningful returns, but you can see that we've been increasing over time. I think the short bias may work on a few selected sectors and items as we go forward, so we are constructive on that. It's been a drag in the past, but both for the use and for the other hedge fund in terms of we left a bit too much of the rally on the table. But I think as we progress with the current valuation set up, there's good opportunity from there. We then move to the painful portion of the presentation for me, and I'm sure for some investors as well, which is Banco Spirito Santo. It's never pleasing or nice to talk about like losses and mistakes, but nonetheless is very, very useful, very instructive, and definitely for us as a portfolio manager, we do spend time. Sometimes you may think in an obsessive way, but we spend time trying to come up with reason, with understanding of where we got things wrong. Banco Spirito Santo, I think there is in this presentation actually there may have been a bit of a mistake because we provide I think we resend the correct one, but I think we were trying to provide the composition of the book concerning Banco Spirito Santo's security across the capital structure, and then across both the month of July and the month of August. In a nutshell, the kind of overriding view there has been since the beginning that Banco Spirito Santo was part of a big conglomerate. We thought the holding company have engaged into any sort of like bad behavior, to use the statement. Quite a bit of the transaction may have been fraudulent. We'll find out only at a later stage, but we thought there was a massive amount of over leverage there. We also thought that the bank itself, which was Banco Spirito Santo, which was the end subsidiary of this big pyramid, was relatively unscathed, and then we were reassured on that by the frequent statements from the Central Bank of Portugal and the very frequent audits and reviews that both independent audits and specific audits of the bank did. And so we started from a short position, a negative position, predominantly through subordinated credit for swaps, and then we sort of moved that position from being short to being constructively a little bit more constructive. Two reasons for that. On the short side, we started having the short both for the hedge fund and the UCITS during the month of July. We made some money. Eventually, we start crystallizing. As we approached the earnings date, which was the end of July, the 29th of July, we transform our short position. Well, there are two main reasons for that. One is because our estimate of the losses was as severe as what happened, but did not include the bank effectively bailing out in retail investors that acquired a security issued by the holding company. We're still very surprised by what happened there, and we actually think that may be one of the main reasons, if not the main reason, why the new management that was appointed to manage the restructuring eventually decided to leave. it sort of doesn't make much sense that the bank decided to basically bail out retail investors that decided for which they only arranged the sale of security of the company at the holdco level. That is effectively equivalent of saying I will burn bondholders in a bank, so then the bank can actually pay par on investors that bought through the bank security issued by other entities which were like fraudulent in their behavior and their activity. That we thought it was very stretched, but that basically ended up in a substantial additional loss that was announced on 29th of July. That was the first reason why we got it wrong. The second one where we got it wrong is that, and that partially based on the statement from Central Bank of Portugal, that kept on saying the bank was safe, was sound from a capital point of view, which was true. It wasn't true once you included the sort of bailing out of retail investors, which we still think will be legally charged. But because of that, we thought that there was, the Central Bank of Portugal said repeatedly there was private capital available and so on and so forth. So we thought even in the case of a resolution, they would have probably tried to do an emergency capital increase and then at the same time transform the lower tier 2 bonds, which is where we lost money, but transform into equity or with a partial conversion, total conversion. And that for us was sort of the worst case scenario. And we structured the position to lose a maximum of 1% roughly on that. It ended up being double the amount because instead of doing this sort of equitization, although forceful, they decided to do a split between good and bad banks, which in the legal scheme of European Union should be something that should become relevant as an option only towards the beginning of 2016. So we're very surprised by that, and that was the second item. The first one was by far the biggest driver of the mistake. The second was a little bit technical, if you want, but again, a bit surprising the way they did it that way. The third reason, which may sound actually a bit irrational, but it's something we've been working on, is that for the last probably 6-9 months before the summer, we did engage into relatively bearish views on specific banks because we thought the regulator would have been tougher and more draconian in their measurements. And unfortunately, because of those positions, we lost money. We had to cut them at a loss. We sort of tried to address our bias, our behavior bias. And we thought, okay, maybe we have been too negative, maybe been too unconstructive on those names. Yes, we were right. It was a bit of a fraud. Yes, the holding company is totally messed up, but it may look that the bank is going to be fine, and there's plenty of buyers for banks, so there will be more capital coming in. And there was a third reason why we effectively turned the position around, if you want, a few hours before the earnings. We were short into that, predominantly through subordinated contracts, in the case of the UCITS, but we turned it around and we actually added to the lower tier 2 because we had other sort of macro shorts that we thought would have been affected by these. And unfortunately, there was a mistake. Whatever we acquired during that period, we effectively lost all of it because then the bonds went down all the way to around 14-15 cents. We did make money on the other piece of the capital structure for the fund. We made money on the senior bonds, which we bought very cheap, and we think the senior bonds are safe money now. The bank will be bought out. They just changed the management over the weekend, partially because the old management was against the bailing out of the retail bondholders, and at the same time was against a quick sale. The government definitely wants to sell the banks. We think they'll be sold very quickly to a much bigger bank, so it'll be a positive event. And so because of that, we made money on the senior bonds. We made money on both senior and subordinated credit default swaps, but the loss on the lower tier 2 was far exceeding. In the portfolio construction we did, we had a maximum loss of around 1% based on the most likely events. We ended up having almost 2% just on that, although mitigated by other items, but that's what happened. So more than happy to have another conversation with the investor in more details on that, but we try to provide, I think in the presentation I have, we just put August, the 29 July onwards twice, but there'll be a new one which we're going to be sending soon where you will see the composition of portfolio with respect to BES during the month of July. We're trying to be as transparent as possible, obviously within the regulatory framework we are in, but we made this mistake. We are very saddened by that, and that's something that, frankly, the portfolio was well positioned for the summer. Without this, we wouldn't have had any losses, but at the same time, we're in the business of trying to make money, and sometimes it happens the other way around. So that's what happened. And but we did incorporate as much as the mistakes, and we keep on going through where and what we'd made wrong, especially with Giovanni, our CRO, and trying to find ways to avoid these in the future. And you never stop learning, unfortunately. But that will be my closing remark on the presentation on these, and very open to any questions you guys may have.
Mr. Lanza, there are no questions registered at this time.
Thank you, everybody. Thank you very much. And if there's any outstanding, you can address it to me or Laura or Stefano and the Edge Invest team. Thank you very much.